All right, today we're going to tear into one of the true titans of the AI revolution, Broadcom. But listen, this is more than just another stock analysis. Think of this as a masterclass in disciplined investing. We're going to break down exactly how to evaluate a top-tier AI company, one that everybody wants a piece of, without getting swept up in the hype. Let's get started.
And that right there, that sentence really hits the nail on the head. It perfectly captures the dilemma we're facing. On one hand, you have an absolute powerhouse of a company. But on the other, there are some pretty serious red flags for anyone thinking about jumping in right now. Our job today is to look at both sides of that coin, so you can make a genuinely informed decision.
So, first things first, let's build the case for Broadcom. Why is Wall Street completely captivated by this company? We have to understand its fundamental strengths, its raw power, before we can even begin to critique its stock price.
Just look at this chart. This isn't just growth. We're talking about a full-blown explosion in earnings, and it's all being driven by their absolute dominance in AI semiconductors. I mean, revenue in that one segment is projected to grow by 65 to 74% in fiscal 2025. This right here is the engine firing on all cylinders.
Now, to really understand how massive that is, let's put it in context. A 40% compound annual growth rate in earnings doesn't just beat the market, it absolutely crushes it. Broadcom is growing 5 times faster than the S&P 500 and almost double the rate of its own sector. This is what best-in-class performance looks like, period. And this kind of performance isn't a fluke. It's built on a foundation that's like a fortress. They have a near monopoly in key AI components, they've diversified their revenue with the VMware acquisition, and their profit margins are just staggering. This is a premium, high-quality asset run by one of the sharpest management teams in the business.
Okay, so if the company is such a beast, what's the catch? What's the problem here? Well, this brings us to the other side of the story, the price. Because a great company is not always a great investment, and the difference usually boils down to what you're willing to pay for it.
And here it is, red flag number 1, a price-to-earnings ratio of 71.5. Now, to put that in perspective, the historical average for the stock market is somewhere around 15 to 20. So you are paying a massive, massive premium for Broadcom's growth. A number like this on its own should make you pause and take a deep breath.
Warning sign number 2 comes straight from the pros. You see this rating downgrade from a buy to a hold? That doesn't mean the company is suddenly in trouble. What it means is that the experts think the stock price has run too far, too fast. The fundamentals are still great, but they're basically saying, hey, we don't see a lot of upside from this price.
But this might just be the most telling signal of them all. When the people who know the company inside and out, we're talking the CEO and the CFO, are selling off huge chunks of their stock, investors really need to pay attention. They're seeing the current price as a fantastic opportunity to take profits. The insiders are selling, not buying. That sends a powerful message. Okay, so we've seen the high-level view. Now it's time to roll up our sleeves and really get into the nitty-gritty. Let's look at these charts and not just see pictures, but read the story they're telling us about momentum and, of course, valuation.
So what are we looking at here? This is a classic smart money chart. See that choppy blue line? That's just the short-term market noise, the day-to-day panic and euphoria. But that smoother green line, the 24-week momentum, that's the real story. It shows sustained, positive strength, suggesting that the big institutions, the smart money, they're using the dips to buy and build their positions for the long haul.
And this chart right here, it visually screams our biggest concern. The valuation has stretched like a rubber band. You can see it went from a pretty reasonable 30 to 35 times earnings back in 2023 to over 70 today. This is a picture of market optimism getting more and more extreme, with people willing to pay a much, much higher price for every single dollar of Broadcom's earnings.
But wait, here's the critical piece of context. Yes, Broadcom is wildly expensive compared to the rest of the market, 132% premium. However, when you compare it to its direct competition, the other big semiconductor companies, it's only about 11% more expensive. So what does that tell us? The entire AI chip sector is priced for perfection. Broadcom isn't necessarily overpriced for its neighborhood, but the entire neighborhood is in a bubble.
So, we've got a fantastic company on one hand and a sky-high price on the other. What do we do? How do we put all this together and turn this analysis into a practical, professional game plan? This is where we go from thinking to doing.
Here's the bottom line, plain and simple. Do not start a new position at the current price. It's just not a smart bet. The combination of that high PE, the analyst downgrade, and the insider selling, it all points to a terrible risk-reward setup right now. This is a moment where patience isn't just a virtue, it's a strategy.
So instead of chasing the stock, we're going to set some traps. We're going to define our entry zones. If you're aggressive, maybe you start nibbling after an 18 to 21% pullback. If you're more conservative, you wait for a deeper 27 to 35% drop, which gives you a much better margin of safety. And then there's the opportunistic zone, below $240. That's the kind of price you might only see in a full-blown market panic, and it could be an incredible long-term opportunity.
Now, what if you're already in the game? What if you already own Broadcom? Well, your strategy is different. It's not about getting in. It's about managing risk. If you're sitting on big gains, it's just plain prudent to trim your position. Take some profits off the table. You don't have to sell everything because you still want exposure to the AI trend long-term, but you absolutely should de-risk when prices get this high.
Look, I get it. The fear of missing out, or FOMO, is a powerful thing. So if you feel like you absolutely must start a position now, here's the disciplined way to do it. It's called dollar cost averaging. You don't go all in at once. You deploy your capital in stages, buying more as the price falls. This takes your ego out of the equation and replaces it with a logical process.
All right, let's bring it all home. No professional analysis is ever complete until you look the risks straight in the eye, weigh the probabilities, and deliver a final, evidence-based verdict.
So here's how the big risks stack up. The most likely risk with a 70% probability is what we call valuation compression. That's simply the market deciding it won't pay this high a premium anymore. The most damaging risk, though, is a broader AI bubble bursting. And of course, you can't ignore geopolitics or the flashing warning sign of all that insider selling. Knowing all that, here's the range of possible outcomes. The base case, the analyst consensus, offers very little upside from here. The real money is made by buying during a pessimistic or even a capitulation scenario. Buying today exposes you almost entirely to the downside, with very limited potential gain in the short term.
So, our final verdict is simple, and it is clear. Broadcom is an exceptional A-plus company that absolutely belongs on your watch list, but right now, it is selling at a premium price that offers a terrible risk-reward for new money. The disciplined, professional move is to wait for a better pitch.
And that brings me to the final question, which is really for you. This isn't about market timing. It's about price discipline. You now have the professional framework to analyze an AI powerhouse. The only question left is, based on your own strategy and your own stomach for risk, where are you going to draw the line?